Are you thinking about starting a side business so that you can take write-offs to save you money on taxes? Well, this does work and works very well. However, it has to be set up correctly. You need to prove it's a real business that you're starting, and you must meet the material participation rules so losses actually count. In this video, I'll show you the step-by-step guide on how to do this the right way so that you don't fall victim to an IRS audit or issues if the IRS were to take a look at it. My name is Merrill Taylor. I'm a CPA. We help high earners and business owners cut taxes proactively. This video is educational in its purpose, and it's not individual advice, so make sure you talk with your CPA before you make any actions. So first off, when it is a business, a real business versus a hobby. With the IRS, we run into what's called hobby loss rules. If the IRS deems an activity to be a hobby rather than a business, you can't take a deduction more than the income. So let's say that the income from that business is $10,000. If your expenses are $15,000 and the IRS deems it a hobby, you can only deduct $10,000 of expenses basically to offset the income. You end up with kind of a wash situation. And the IRS looks for a profit motive to determine if you are running a business or a hobby. A true business deducts ordinary and necessary expenses, whereas a hobby does not. The regulations list 9 factors on how business-like you run it: your expertise, the time and effort you put in, your history of income and losses, and whether you expect the assets to appreciate. There's a presumption if you show a profit in 3 out of 5 years that it's considered a business, but that is not a magic shield. It's not something that will automatically qualify. It's just a kind of a safe harbor of some sorts. So you're going to want to run your business like a business, keep a separate bank account, maintain books, send invoices, and have a plan to make money. You could also consider setting up an LLC just to keep you safe for legal purposes. You don't necessarily need an LLC to run a side business. A lot of people think you need an LLC and it's going to do something magical for taxes. That's not the case unless you elect an S-Corp for that LLC, which may or may not be a good idea. You can watch some of our S-Corp videos to determine when that makes sense. But the important point is you don't always need an LLC to run a business. Now, what can you write off when it comes to the business? Before you open your doors, amounts you spend to investigate, create, or launch the business are considered startup costs. And once you're active, the ongoing costs are operating expenses. This falls under the IRS Code Section 162 as ordinary expenses, and you can generally deduct ordinary and necessary operating costs right away. However, the startup and organizational costs that we mentioned, you can only deduct up to $5,000 of the startup costs and up to $5,000 of organizational costs in the year your business begins. And those are reduced dollar for dollar if each category exceeds $50,000 on those. If you're above those amounts, then the rest is amortized over 180 months, which is 15 years, which is a kind of a crazy thing, but it's just the way the rules work. This applies to corporations, partnerships, sole proprietorships. And then your business begins when you are open for business and performing the activity. Costs before that are startup costs and are not current deductions. So keep that in mind. A lot of times people will start a business. So let's say we're in 2025 here. People start a business in November of 2025. They incur $20,000 of expenses between November and December, and they actually don't even really open doors or really get the business operating until, say, 2026. Well, unfortunately, all those costs that you've incurred, that $20,000 of costs, cannot be deducted until you actually start the business. And then when you start the business, they're subject to those limits. You can do up to $5,000 when you get the business actually started, and anything above $5,000 would be amortized over a 15-year period. So just keep in mind that you want to keep your costs very low while you're getting started, and you want to open your doors and get that business up and operating as soon as possible to avoid those limits. All right, so what are things that can be written off in the business as you get going? Well, there are tangible items like gear, laptops, tools that you need to buy. You may expense small items using the IRS de minimis safe harbor rule, which is generally $25,000 per invoice or per item, or $5,000 if you have an applicable financial statement, which is a very rare occurrence. Usually we're dealing with the $25,000 exclusion on there. And then, basically that means, if you were to go and buy a computer for $1,000, it's under $2,500, so you don't have to depreciate it over, say, a 5-year period. You could just write it off all at once. So that applies to anything that's $25,000 or less. The bigger purchases can be expensed with a Section 179. We currently have the bonus depreciation that's 100% for 2025 and for the next several years. So we more use bonus depreciation rather than 179. 179 runs into limits. You can't actually create a loss in a business through 179, but bonus depreciation can create a loss. And so we're in a world where we pretty much use bonus depreciation for everything and not 179 as much. All right, and then you also want to look at deducting like a home office and vehicle expenses. So if you use a space regularly in your home and it's exclusively used for business, you can use the simplified method of $5 per square foot up to 300 square feet. So in that case, you could get like a $1,500 write-off if your home office was 300 square feet, or you can use your actual expenses and fill out Form 8829 on your personal tax return. Now, employees can't claim this home office, unfortunately. It's for self-employed business owners. And then for vehicles, the 2025 standard mileage rate is 70 cents per mile for business miles, or you can use the actual expenses if you keep your detailed records. Now, how to launch so deductions stick so that they actually count for you? Well, one, you want to pick your structure. You can be a sole proprietor, which is just going into business for yourself. You don't need an LLC or any type of legal entity. Basically, if you get paid in any sort of way that's not an employee, if somebody's paying you for doing work and you're not an employee of that person, you're basically considered to be a sole proprietor. Regardless of whether you have an LLC, business license, or anything else, you are, for tax purposes, a sole proprietor. So you could set up as a sole proprietor. You could go set up an LLC and operate that way. You could set up a partnership. You could set up a corporation. Your entity choice doesn't create deductions. It doesn't. Under those scenarios, sole proprietor, LLC, partnership, corporation, your income and expenses are going to be the exact same. It doesn't make a difference on what you conduct and what you cannot. It does affect payroll taxes and how you pay yourself. Now, you will want to get an EIN, an employer identification number, if you're having employees. You want to open a separate bank account for that business. You want to set up bookkeeping for that business, keep track of your books and things. Track pre-opening costs as startup, so anything before you open that business are startup costs. And then once you're open, then you can track your operating versus capital purchases at that point. At tax time, you want to elect the de minimis if you use it for the expensing things that cost $2,500 or less. And then look at the bonus depreciation, maybe 179, but more so bonus, and then claim the startup and organizational deductions as well. Now, an important part of running a business and being able to offset, say, W-2 income or other business income is that you have to have active participation in that business. Now, that helps to make those losses deductible. And then 2 rule sets can block losses. First, the at-risk rules. You can only deduct losses up to the amount you are personally at risk. So you have to have cash invested into the business, basis of property that you contributed counts as at risk, and loans that you are personally liable for also come with an at-risk loss there. And then losses beyond that can be suspended. Second, the passive activity rules. Losses from a passive activity generally cannot offset wages or other non-passive income. So to make your new business non-passive, you must materially participate in that business. And the IRS has 7 tests that go through those. The most common are the 500-hour tests. So participating in that 500 hours or more during the year makes it an active. There's also a substantially all participation test, or more than 100 hours and no one else worked more than you. The 100 hours is generally kind of one of the easier ones to hit, that you participate in the activity for 100 hours and then you kind of keep track of everyone else's activity in that business, and as long as you work more than anybody else, which if you're a sole proprietor, you're usually the only one working, so if you had 100 hours in that, then you are materially participating, and you can then use that as an active loss to offset, say, W-2 income or other business income. You want to keep contemporaneous time logs, such as calendar entries, time tracking, task notes, just to prove the amount of hours that you have put in during the year. So what is active participation? Well, that phrase applies to rental real estate and is different from material participation. So if you own a rental property and you actively participate, like you approve tenants, set rents, authorize repairs, you may claim up to a $25,000 special loss allowance from real estate, which phases out from when your income is between $100,000 and $150,000, so it's available in full for income under 100,000, phases out between 100,000 and 150, and then once your income is 150,000 or more, then that benefit completely phases out. And that's separate from starting an operating business, but many side hustlers also have rentals, so it's important to know the difference between those two. All right, so let's run some examples here. So example one, we have a consulting side business. So let's say you spend $3,800 before the business begins on pre-launch expenses. You're doing market research, branding, maybe getting a website put together. Those are all considered startup costs. And after opening on March 1st, you buy a $1,900 laptop and a $400 microphone, and you drive 1,200 business miles during the year. Well, you can deduct the $3,800 of startup costs within the $5,000 limit. Since those are under $5,000, they're fully deductible. You may expense the laptop and the microphone under the de minimis safe harbor because each of those items are under $2,500. And then for the vehicle, the 1,200 miles times 70 cents equals an $840 deduction. If your first year net shows a loss and you worked 500 or more hours, or the 100 hours, or you meet one of those material participation tests, then your loss is considered non-passive and it's just subject to the at-risk limit. So as long as you're at risk in that activity, you had at-risk investment in there, you could actually deduct that loss from that business and offset W-2 income or business income. Let's take another example. Example number two, we have an equipment-heavy launch. So you buy a lot of equipment. So you start a landscaping business and buy $85,000 of gear. In 2025, you may expense much or all of it via the 179 or bonus depreciation, the one that we use more often, depending on the facts. In this case, you're going to want to coordinate with your CPA to avoid creating disallowed losses if you're at risk and material participation tests aren't met. In this case, you're buying actual gear, 85,000, say, of equipment that goes in. That's actually, equipment's generally not considered a startup cost. It's considered a capitalized cost that you can depreciate over time. And so that wouldn't necessarily count toward that as a startup cost. So anyway, it gets a little more complicated. Make sure you consult with your CPA on how that works. Okay, some common mistakes that people run into with this. So it's calling the activity a business, but not keeping any books. In order to be a business, you need to treat it like a business. You need to have books and bookkeeping, and you want to have a separate bank account and have some kind of a business plan. Most businesses don't have a written business plan. Having a written business plan would certainly help in case of an IRS audit, not necessarily required, but at least have a plan, and you have to have some kind of a plan for running that business. Deducting personal costs can also be a trap. If you're doing personal travel or personal meals or your personal car, using your personal car without any kind of logs, got to be careful there. It's kind of mixing business and personal type stuff. And then another common mistake is start in December and assume everything is a current deduction. Many pre-opening costs are startup costs, and claiming a loss with no time logs and then failing the material participation test can be an issue as well. And then another common mistake is ignoring the at-risk limits, especially if you're financed equipment with non-recourse loans. So keep an eye on that. All right, some quick fire, some Q&As to go through here, just kind of a recap. First off, can you deduct losses in year one? Yes, you can if you're at risk and you materially participate, so it's not passive. Otherwise, losses could be suspended. Do you need an LLC to do deductions? No, you do not. Deductions come from having a real business with a profit motive, not from any type of entity. Is a spare bedroom deductible? Yes, it certainly could be if it's used regularly and exclusively for business. The simplified method is $5 per square foot, up to 300 square feet, or you could use the actual costs in that as well. How do you keep track of your car? You want to keep a mileage log for that. So the 2025 rate is 75 cents per mile for business. You could also deduct the actual expenses based on your business use percentage. Either way, you're going to need to keep a mileage log because you'll have to prove to the IRS what your business use is. And then finally, what if I'm losing money? Will the IRS call it a hobby? It says losses are fine if you're genuinely pursuing profit. You want to know the 9 factors and make sure you're running your business like a business. All right, so what do we do next? You want to open the business properly, separate finances, track startup versus operating costs, make the right elections, and document your hours. And if this video was helpful for you, make sure you hit the like and subscribe button. Share this with someone who owns a business or is launching a business. This will be helpful information to you, and we'll make sure to keep you updated on any changes that happen with these laws.